Hey everyone, welcome back to my channel. In today's video, I want to dive into a topic that is super important but often misunderstood: credit. Before we get into things like credit repair or credit building strategies, we need to start with the basics. So let's begin with the question. What is credit? At its core, credit is the ability to borrow money or access goods and services with the understanding that you'll pay back the lender or provider later. When you take out a loan, use a credit card, or even get a mortgage, you're using credit. But it's not just about borrowing money, it's also about trust. The lender is trusting you to repay what you owe on time based on your financial history and other factors. This is where the idea of a credit score comes into play. Your credit score is a reflection of how trustworthy you are as a borrower, and it can have a huge impact on your financial life. But we'll get into that in another video. For now, just think of credit as a tool that helps you buy something today while promising to pay for it in the future. There are two main types of credit: revolving credit and installment credit. Revolving credit is what you get with a credit card, where you have a limit and can borrow as much as you need up to that limit, then pay it off over time. Installment credit, on the other hand, includes things like auto loans or mortgages, where you borrow a set amount and pay it off in fixed payments over a period of time. Credit isn't just about buying things either. It's about building a financial reputation. When lenders, landlords, or even employers check your credit, they're looking at how you've managed your finances in the past to predict how you'll handle future obligations. Understanding credit is the first step toward making smart financial decisions. In future videos, we'll get into how to repair or improve your credit. But for today, remember, credit is all about trust and responsibility. Most credit scores range from 300 to 850, and the higher your score, the better. A good score can open doors to better interest rates, larger loan amounts, and more financial opportunities. But here's the thing: credit isn't just about getting access to money. It's about how you manage debt and prove your financial responsibility over time. So how is your credit score calculated? There are a few key factors that influence your score, and understanding these can help you make smarter financial decisions. Let's break it down. Overlay of factors affecting credit score: payment history, credit utilization, length of credit history, new credit, and credit mix. Payment history: this is the most important factor. It makes up about 35% of your credit score. Lenders want to see if you've made your payments on time. If you've missed payments, defaulted on loans, or had accounts sent to collections, it can have a major negative impact on your score. Credit utilization: this is the ratio of how much credit you're using compared to how much you have available, and it accounts for 30% of your score. For example, if you have a credit card with a $10,000 limit and you've used $5,000 of it, your utilization is 50%. It's generally recommended to keep your utilization under 30% to avoid hurting your score. Length of credit history: lenders like to see a longer credit history because it gives them more data to assess your financial habits. This factor makes up 15% of your score. So the longer you've had credit accounts open, the better for your score, especially if you've been responsible in managing them. New credit: this looks at how often you've applied for new credit recently and makes up 10% of your score. Opening too many new credit accounts in a short period of time can be a red flag to lenders, as it may suggest that you're desperate for credit or taking on too much debt. Credit mix: finally, 10% of your score is based on the types of credit you use. Lenders like to see that you can responsibly handle a mix of different types of credit, such as credit cards, auto loans, and mortgages. Having a diverse credit portfolio can boost your score. Now that you understand the factors that make up your credit score, you can see why maintaining good credit habits is so important. Credit isn't just about borrowing, it's about showing that you can borrow responsibly and pay back what you owe on time. When you do this, lenders are more likely to approve you for larger amounts of credit, offer you better interest rates, and trust you with more significant financial responsibilities. Let's take a moment to talk about why having good credit is essential, especially for big life goals. If you're looking to buy a house, a car, or even start a business, your credit score will play a major role in determining whether or not you get approved for a loan and what terms you receive. A higher credit score generally means lower interest rates, which could save you thousands of dollars over the life of a loan. on the flip side. If your credit score is low, lenders may either deny you credit or offer it at a much higher interest rate. But it doesn't stop there. Your credit can affect other areas of your life too. Landlords may check your credit before approving you for a rental. Some employers, especially in financial services, check credit reports as part of their hiring process. And in some states, even your insurance premiums can be affected by your credit score. Having good credit gives you financial freedom. It means you can take advantage of opportunities when they arise and make significant life choices with confidence. On the other hand, poor credit can limit your options and lead to higher costs in the long run. But the good news is that even if your credit isn't great right now, there are ways to improve it. And that's where credit repair comes into play, which we'll talk about in future videos. In summary, credit is more than just borrowing money. It's about building trust with lenders, proving financial responsibility, and setting yourself up for a stable and secure future, whether you're just starting out or looking to improve your current credit situation. Understanding how credit works is the foundation for making smarter financial decisions.